You didn't lose that trade when the market turned against you. You lost it the moment you moved your stop loss. And if you're honest with yourself right now, some part of you already knew that before I said it. Every trader sets a stop loss with confidence. They place it exactly where the chart tells them their idea is wrong. They feel disciplined for about 4 seconds. Then price gets close. They watch the line. They watch their own hand drift toward the mouse. They give it a little more room, because surely the market is just shaking out weak hands before it goes their way. They watch the small loss they planned for quietly turn into the big loss they swore they'd never take. And afterwards, staring at a red account, they ask the same question almost every losing trader has asked themselves at 2 in the morning. Why does the market always seem to hit my stop and then reverse? Here's the truth nobody tells you in the beginner courses. A stop loss is not a rough idea of where you'll get out if things get really bad. It is not a suggestion you reconsider once your emotions wake up. It is not a number you're allowed to renegotiate with yourself in the middle of a trade. A stop loss is a contract. It's a promise you write down while you're calm to protect yourself from the version of you that won't be calm 5 minutes from now. Once you understand that, something shifts. You stop seeing the stop loss as the thing that costs you money. You start seeing it as the only thing standing between one bad trade and a blown account. An amateur sets a stop loss because a video told them to. A professional sets a stop loss because they know the exact price where their original idea is proven wrong. And they know it before they ever click buy. By the end of this video, you'll know exactly why moving that stop is costing you far more than the trade in front of you. And you'll have a protocol you can use today to stop doing it. Let me tell you about Daniel. Daniel started with a $20,000 account and a system that, on paper, made sense. He risked 2% per trade, $400, and his rule was simple. If price hit his stop, he was out. No negotiation. But in practice, Daniel had a habit. Every time price approached his stop, he found a reason to give it more room. A $400 planned loss would quietly become a $1,200 loss, sometimes $1,800. Over 4 months, without ever blowing up on a single dramatic trade, Daniel watched his account bleed from $20,000 down to $9,200. That's a 54% drawdown, and not $1 of it came from bad analysis. Every dollar came from a stop loss he refused to respect. An amateur moves their stop loss when a trade turns against them. A professional only ever moves a stop to lock in more profit, never to give a losing trade more room to keep losing. Then Daniel made exactly one change. He stopped treating his stop loss as a conversation. He placed a hard stop order the second he entered a trade, not a number he'd watch closely. An actual order sitting on the exchange that he was no longer free to override in a moment of fear. Over the next 5 months, his win rate barely moved, still sitting around 46%. But his average loss dropped from $1,150 to $410. His profit factor, simply the ratio of money he made to money he lost, climbed from 0.7, meaning he was losing more than he made, to 2.1, meaning every dollar he risked and lost was now earning him back more than $2 in profit elsewhere. His account climbed from $9,200 to $15,800. Daniel didn't find a better strategy. He found a stop loss he was no longer allowed to argue with. Let's do the math, because the math is what makes this real instead of just a nice story. Say your plan is to risk 1% of your account on every trade. 10 losing trades in a row, which happens to every trader eventually, even good ones, brings your account down by roughly 9.5%. Painful, but survivable. Now say you quietly widen your stop a little more than planned, on average doubling your true risk to 2% per trade without ever admitting that to yourself. That same 10-trade losing streak now costs you 18% of your account, nearly double the damage, from the exact same 10 losses, the exact same market, the exact same strategy. The only thing that changed was whether you respected the number you wrote down before the trade existed. Here's how position sizing actually works for professionals. Take the dollar amount you're willing to risk, divide it by the distance from your entry price to your stop loss, and that tells you precisely how many shares or contracts to buy. The stop comes first. The size is built around it. The moment you move the stop after the trade is already live, every calculation you made before that trade became a lie the second you touched it. An amateur deletes the stop loss entirely, just this once, convinced this particular trade is somehow different. A professional treats deleting a stop loss the same way they'd treat handing a stranger their bank card and reading out the PIN. So why do smart, capable people keep doing this to themselves? Because your brain was never built for this. When price creeps toward your stop, your amygdala, the small part of your brain responsible for detecting threats, fires off a stress response. Cortisol floods your system. Your body reacts to a 2% account drawdown roughly the same way it would react to a predator stepping out of the bushes. In that state, your prefrontal cortex, the rational planning part of your brain that built the trading plan in the first place, goes quiet. The version of you that calculated the stop loss is not the version of you that's actually in charge when price gets there. On top of that, decades of behavioral research have shown that humans feel the pain of a loss roughly twice as intensely as the pleasure of an equal gain. That's called loss aversion, and it isn't a character flaw. It's wired into every human being who has ever lived. Your nervous system would rather risk a much bigger, uncertain loss later than accept a small, certain loss right now. Moving your stop loss isn't weakness. It's your biology doing precisely what it evolved to do. The problem is that the same instinct that kept your ancestors alive in the wild is the one quietly draining your trading account today. An amateur blames the market for hunting their stop. A professional asks a harder question. Was my stop sitting inside the noise, at a price any normal wiggle was always going to reach, regardless of where this trade was actually headed? So here's what actually works, and I won't pretend any of it is easy. If it were, every trader would already be doing it without a second thought. Rule 1. Decide your invalidation point before you ever enter the trade. Not where it would hurt to lose. The exact price where your original idea is proven wrong. That number and only that number is your stop. Rule 2. Calculate your position size from the stop, never the other way around. If a tighter stop means a smaller position, take the smaller position. Never widen the stop to justify the size you wanted in the first place. Rule 3. Place the stop as a real order the moment you're in the trade, not a number in your head you'll watch closely. A mental stop is not a stop. It's a decision you've already half made to break. Rule 4. Build yourself one honest question for the exact moment temptation hits. Before you touch that stop, ask, has new information actually appeared, or am I just afraid? Almost every time, the honest answer is fear. Rule 5. If you do adjust a stop mid-trade, only ever tighten it to protect profit. Never widen it to give a losing trade more room to keep losing. Rule 6. Write down every stop you move, and write down what it cost you in real dollars. Most traders have no idea how much money this single habit has taken from them, because they never once wrote it down. Make the damage visible, and it becomes a lot harder to keep doing it quietly. And Rule 7, the hardest one of all. Stop treating a hit stop loss as a failure. A stop loss that does its job is not a loss. It's a successful, paid-for test of an idea that turned out to be wrong, at a price you agreed to before fear ever walked into the room. You didn't lose that trade when the market turned against you. You lost it the moment you stopped trusting the calm version of yourself and started listening to the scared one. A stop loss respected is protection. A stop loss negotiated is permission to bleed. A stop loss ignored is a slow, quiet way of giving your account away. One reasonable-sounding excuse at a time. Discipline with your stop loss creates survival. Survival creates the time you need to actually get good. And time, more than any strategy, more than any indicator, is the one asset every consistent trader eventually has that everyone else gave away first. The market isn't taking your money because your stop loss is wrong. It's taking your money because somewhere in the middle of the trade, you quietly decided your stop loss was optional. If this hit something real for you, if you've ever watched your own hand widen a stop you swore you'd respect, type the word stop in the comments because I can promise you, you are not the only one. And if you want the rest of this system, including exactly how professionals decide where to place a stop loss before the trade even begins, subscribe, because that's exactly what we're building next.